All right, all right, all right. Hey guys, welcome. It is Wednesday. It's live at 4:44 instead of 5. On a little bit early. It is Thanksgiving Eve, if that's a thing. Myself, Jeb Smith, and Josh Lewis, mortgage professional, and myself, a real estate agent, here to, maybe talk. I don't know if
Talk
people have
turkey.
questions. Yeah, talk turkey. Josh has an 805 over there supporting the cause still. So yeah, we're here to answer your real estate mortgage questions, have a little dialogue back and forth, hopefully help you guys with thoughts on the housing market, all that good stuff. But before we get started, just want to say thank you. It is Thanksgiving, right? Or the day before. Still here doing our thing as we promised every week that we would. But I did want to say I'm grateful for all the support you guys give. You guys show up every week, ask questions, and make the show what it is. So we appreciate that, and I want to thank Josh also for being a part of that. And again, without Josh here, I don't think we'd have the viewership because a lot of people show up to get those mortgage questions answered. So thank you, bud. Welcome. How's the shoulder? Update, all that good stuff.
It's definitely getting there. We saw the doctor today, or not today, on Tuesday or Monday. I don't remember. All days run together when you're hopped up on drugs recovering. But 26 staples removed. That was fun. Doctor says it's all beautiful and coming together. So slowly, about 1% better a day is what I'd say.
Got it. 1% better. So with full recovery in 100 days, is that what we're thinking? Or
We're probably
what's
going to have to
the
slow down the
prognosis?
pace then, because the doctor said it's a year. It's a year before it's recovered. But 3 months, you're good for cruising around doing your day to day. 6 months, you can start rebuilding your strength and getting after it. So we'll see. If we had any strength, we should be able to regain it.
No, awesome. So with that said, a couple things out in the housing world, if you will, over the last week. Fed met today, and there was some, every every month they I guess survey the Fed members to some extent to figure out where they are stance wise on raising rates and all this stuff. And percentages are changing a little bit. Looks like it's becoming a little bit more of the Fed seems to think that they should raise interest rates sooner rather than later. Maybe, instead of slowing the bond tapering or starting off slow to pick that up so that they can get past it and start raising rates and so on and so forth. So thoughts on what they said, thoughts on the market in general with regards to that, how are rates doing? Let's give a full update.
Yeah, what they said is sort of them coming to the realization a little bit late of what everyone else had. The markets would have liked to begin the tapering 2-3 months sooner, and the Fed continued to say, no, we're going to wait for the employment picture to look stronger, the employment picture to look stronger, the employment picture to look stronger, and obviously it's very strong. We go back to the long-term demographic trends of an aging baby boomer generation exiting the workforce, not as many people coming in behind them. So when you have that, labor force is going to be tight. Employers are going to have a tough time finding qualified employees. They're going to have to fight over them. And the lower end, I forget, I actually saw this as a fancy term for the minimum amount that people are willing to do a job for. Like most of us, when you're a grown adult, you don't want to work at McDonald's, but there's a number there for the people that they need to apply this, and that number is going to continue going higher. That's where the wage growth inflation is happening, is primarily at the lower end. People needing to take those jobs, people having jobs like that they need done, are having to pay more for unskilled, non-college educated labor, and that will continue to go up. So the Fed didn't need to wait as long as they did to see that the economy is strong from an employment perspective. Things are relatively good. We still have major supply chain issues, and on top of that, we have major increases in demand, basically for all of the time that people were stuck at home and couldn't go out and buy the goods that they wanted, and because of the stimulus that was put into the economy. So people with a lot of money looking to spend it and having a hard time getting all of those goods into consumers' hands. I had a chart here earlier today, and it showed this massive spike in the goods economy, which for the longest time, going back to the 70s and 80s, we've been transitioning to primarily a service economy, and all of the growth since the pandemic has been in goods. Nothing has changed. We as consumers haven't demanded more goods. The thing that changed was our ability to get them, our ability to purchase them in terms of having money, and that brief period of time, 6-8 months, where you couldn't get it at all. So big picture, the more hawkish the Fed gets in the short run, the better off we'll be, and the quicker we'll see the return of lower yields. Right now, the economy, the markets are rightfully afraid that we're seeing inflation a little bit out of control. The Fed behind the curve on this, and as a result, yields have popped up. So yields, what does it mean? You still have really, really good interest rates. The best qualified conventional borrowers are in the very high to very low, very high twos to very low threes. FHA borrowers, we got a big rebate for a well-qualified FHA borrower yesterday at 2.875. You can still get that 2.5% FHA if you're not looking for a lender credit to cover closing costs. So it's important to put into perspective that pre-pandemic, today's interest rates would have been viewed as spectacular for everyone. We would be in the middle of a refinance boom right now if rates had dropped to the level that they're at right now. And the reason that we aren't is almost everyone has taken advantage of those rates. So what are we seeing? Purchasers still taking advantage of buying a home and financing with really low rates, and people who are looking at record levels of equity in their home using the good terms today to reposition some of that equity to pay off debt or finance other things in their lives. So overall, Fed was right on with what they're doing if they're a little bit late to the party, which most of us think that they are. But things are not bad for this time of year. So in terms of being thankful, we're thankful that the rates are still good, economy is still good, a lot of people still back in jobs and able to qualify for homes, whether it's a refinance or a purchase.
No, absolutely. Yeah, I mean, rates are great. We're going to get some news here soon about loan limit changes with regards to Fannie and Freddie and new loan limits. Right, that'll be probably within the next 10 days, week.
We would expect the 30th. We'll get that. So what is that? 6 days. So
Yeah.
next Tuesday is when we'd expect. And the best people that are sort of reverse engineering the numbers. Most every lender is doing 625 as of today. Most people are expecting it to be closer, but maybe not all the way to 640. So
Yeah.
if it's 640, you're looking at a 960 high balance. The thing that's going to be more interesting to me, I don't know if we've talked about this on the show, but if you go back 3-4 years ago, like a county like San Diego County, they had high balance loans, but they didn't have the full high balance, meaning that you couldn't go all the way to 150% of the standard balance loans. And even now, they're like $8,000 or $9,000 short of it. With the appreciation they've seen this year, San Diego will go to a full high balance county where everything can do 150% of the standard balance limits. What's going to be really interesting next Tuesday when we see that announcement is which counties move up and get either a partial or full use of that high balance. Like, to me, it'll be very interesting. And I don't know how they do the calculations, so this is pure speculation, but Riverside and San Bernardino counties have seen some really big increases. I wouldn't be surprised to see them get high balance loans, not all the way to 150%, but we could get some measure of that increase above and beyond. So
No, and that would be big. I mean, that would be a big give buyers in that market another opportunity to go up in price. Some are capped and can't go any higher because of that. And I've done videos and talked about that. But let's talk here about the market in general, right? We talk about inventory and that every single week. So here today in Orange County, we have 1,448 homes on the market, right? So you've heard me say the inventory is going to continue to get tighter through the end of the year. Not just here in California, it's going to happen pretty much everywhere for the most part. Inventory is going to continue to go down. I mean, over the last, probably month, we were close to 2,000 properties within a month ago, and now we're sitting at 1,400. So we've dropped 20%, 25% in that time frame. And so that doesn't mean there's no inventory coming to the market. It just means whatever is coming to the market is being met with some demand. And then here in Huntington Beach, let's talk about that because I always do it too, just a reference. I mean, many of you aren't here. We have 108 108 properties on the market. I think last week we were at like 122, so 121, somewhere in there. We're in 108. So inventory is going to continue to get worse. If you're buying a home, it is going to feel very frustrating over the next couple of weeks because there's going to be less and less property to choose from, less opportunities. It's just tough. But as the year turns, it's not going to happen on the first day of January, typically, right? It's not going to happen January 1st or whatever. It's going to take a little bit of time for the inventory to start to build, which should give you some more opportunities out there, which we've talked about many, many times in all of this. But let's just talk here about what I'm seeing, right? Use this as a reference. Real estate's local, so this might not be happening in your market, but here locally, listed a property on Friday, 7 offers, and sold for $85,000 higher than where we listed. So we listed it at $995. We received 7 offers over the weekend. I don't have the comparison right in front of me, but we accepted a cash offer at $1,080,000 with a 10-day escrow. Yeah, 10 days, 180,000, so 85,000 over that price. And quite frankly, that price at $995 to me was towards the high side of what it should have been listed at. Now, I thought it would sell over $1 million just because of the demand, but I didn't think it would go that high. So there's still a lot of buyers out there willing to purchase. In this case, you ask, where'd the money come from? This particular buyer received money from a family member, cash. There's an inheritance of some sort. That's a lot of money to get it, but there were some transfers of money. Anyhow, and then even then, so we still had under that, we had an offer at $1,070,000, $1,050,000, $1,020,000 was one, and I'm forgetting, and there were a couple right at the asking price, but just shows you how competitive it is still in the market. So, it's so frustrating for me when I see other people talk about the housing market or watch videos or whatever, and they're talking about how there's no buyers out there and there's no whatever, and it's these are a lot of these people talking about the housing market aren't in the housing market. And it's super frustrating. They don't sell property. They're not real estate agents. And think what you want about real estate agents. But the fact is, boots on the ground. I'm out there helping sellers and helping buyers and trying to use that real world experience to help you guys navigate the market, right? I'm not here to tell you to buy a house or sell a house. It's just, hey, this is what I'm seeing. Maybe you can use that to help yourself, to help benefit. What are people doing in the market and that sort of thing. So that's what's happening in my world at the moment. Now, I've talked to a couple of people here over the last couple of weeks that are interested in selling their property. I've told you, typically this is the time of the year where things slow down, right? I mean, I'm not listing a bunch of houses this time of year just because generally that's not what people do, right? If they were going to list, they would wait till after the first of the year. I'm having a lot of conversations now about people potentially listing now, maybe job relocations, or maybe they're just interested in moving, taking advantage of the market or whatever it is. But that just, there's a lot of people out there thinking about it, which tells me you're going to have a hot spring. There's going to be inventory to choose from. Rates are probably going to stay low. So there's going to be buyer demand, but it's going to be maybe not a repeat of last year, but I think you're going to see a competitive market moving forward.
Jeb,
Anyway.
you just actually covered several of the questions that we have here. So
Right.
let's just kind of bounce through them and relate it back to what you just said. So Juan says, if rates increase next year, will prices continue to increase or decrease? If rates went high enough, it will absolutely turn the market around. So what is that level? What is that? Probably somewhere around 4%. And I don't think there's any chance that rates go to 4%, but you should be aware of it. That if we get, much above 3.75 to 4%, it would have a negative impact on interest rates. Just to put that in perspective, for a 30-year fixed rate to get to 4%, it means we need to be about 2.7% on the 10-year treasury. And we've had a hell of a time getting above 1.7% despite all of the inflation fears. So treasuries have to move up a full percent to get us to that point. And I just don't see that happening. So the other thing here, Jeb, that popped in here. Alberto Gonzalez Ruiz says, do you think the market will correct itself or will it continue to rise at a slower rate? and you can jump in on that. I mean, are we going to correct, or are we going to rise at a slower rate? We don't necessarily have to rise at a slower rate. Probability would dictate that we're not likely to have another year of 16, 17, 18, 20% increases, just because as the prices go up, you're decreasing demand in terms of able buyers. So demand decreases just because there's fewer people able to buy those homes. And as Jeb was saying, I wouldn't be surprised to see a small increase in supply next year, just because people are getting tempted by the volumes of equity they've built up in their home.
Yeah, I mean, when I finished saying what I said a minute ago and we started the conversation, one thing I often hear is like, people are buying these houses at these crazy prices, and that's what's going to cause the market, right? Because people are buying, like, for example, use the one I did a minute ago, listed at 995, they bought it at $1,080,000. Because people are doing that, it's unhealthy for the market, which is going to cause the prices to go down. Think about this for a moment, though. So that buyer bought it cash, $1,080,000. If the property goes down 50%, what the hell do they care? They have no mortgage. It doesn't affect that person in that case. Now, it does affect the person that has to sell a property, has to move, has to do something for whatever reason. But how often is that the case? Like, the percentage of people selling property aren't selling because they're having to do it. They're selling because it's a want. It may be a need in some cases, right? Me, I live in a 3-bedroom property, just under 2,000 square feet. I have 3 kids. I need more space, but I don't have to have more space. I'm looking for opportunities that give me that space. Also considering an addition, like, there are things that I'm doing to offset it, but I'm not in a position where I have to do anything. And I think that's the majority of people out there that do move, is they don't move because they have to. They move because there's maybe a need, a want, if you will, or there's a job relocation in that sort of thing, which those are going to happen. But it's not what's going to change the market per se. So if you do see a pullback in price, I mean, the majority of buyers that I've represented over the last year, I would say the majority, I don't know the numbers right off the top of my head. This is something I should calculate for a video, but I don't know how many people in that deal put less than 20% down. I mean, the large majority of people that I've represented over the last year put at least 20% down. So if the market does pull back a little bit, which I don't expect, at least over the next year, I don't think you're going to see a pullback in prices. I think to answer the question, I think you're going to see more of maybe in the spring you see a big pop, because buyers being able to get that property, jumping in, whatever. So maybe you see a big increase at the beginning of the year. Maybe, again, this is merely a guess, 5, 6, 7% right to start. And then from there, you see a moderation, right? Once those buyers that have been waiting are able to get in, finally purchase a property, you take some of those out. If inventory is still there, you probably see more of a moderation in the climbing of prices at that point. So just my thoughts. But we don't, there's no certainty in any of this.
No, and Jeb, one of the things that I like, to walk through with folks that show up here that are saying, this can't go on, this has to crash. There's going to be a crash. It's going to correct. You say, okay. One of the things that was floating around in 2005, 2006, 2007 was the thought that nationally we've never had a decrease in home prices, which nationally doesn't matter. It only matters about your market. And many markets prior to that had corrections to real estate prices, and we ended up seeing it on a national level because of the mortgage crisis. But another point that was lost in that process and was sort of dismissed is the fact that home prices are sticky to the upside. It's different than other investments. If you buy Tesla stock or you buy Bitcoin and it starts tanking and you get uncomfortable, you sell that, because it's as simple as walking over your computer, pushing a button, selling, liquidating, and saying, thank God I don't have any more losses. Now, if you wanted to run to the curb, put a sign in the yard, and sell your home, still 30 to 60 days to make that happen. You're paying a chunk of your equity in commissions, and then you're left with the decision of, Where am I going to live? What are my alternatives? Jeb has 3 kids. Can he go rent a 1-bedroom apartment for he and his wife? No, he cannot. He needs a 3-bedroom house. It's
We
probably
get
going to
kicked out real
You'd get
quick.
kicked out. He would go rent a 3-bedroom house or a 4-bedroom house, and it would cost more than what his home costs to own right now. So when people look in terms of selling, it's a home is not a pure investment. They don't sell just because there's maybe a little bit of downward pressure on sales. In a down market, the only people are selling are people that have to sell. People in financial distress, people that got a job move and their company's paying for the loss they're going to take on their home. So doesn't it's not a way of saying that home prices never go down. It's that home prices are very resistant to going down for those reasons. And when we see a correction, it's generally more in that 7 to 15% neighborhood of correcting. And based off of supply demand fundamentals right now, neither Jeb nor I believe we have any risk of seeing a decrease in home prices in the next 12 months.
No, it's funny. Like, I was watching Graham Stephan, his video, one of his videos that he posted today. I don't know if it's his latest one or one of them. And I'm sure many of you out there are familiar with Graham. Just, he's been around the YouTube game for quite some time. But he posted a video, and in the video, he shows clips of basically a crash being called every single year for the last however many years. So he shows a headline. Every single year it basically says the same thing. And it goes back, I forget what the year it started, maybe like 2010 or 2011 or whatever. Every year, crash, crash, crash. I mean, and yet we still, so there's always been this idea that there's going to be a crash because of something in the market, right? There's, in his deal, like it's a crash on EV stocks, right? Because the whole electric vehicle world has gone bananas. And then there's one on the housing market, and there's one on whatever. And it's speculation, right? And it gets views, it gets headlines, it gets people to watch it, so on and so forth. But let's move on here. Josh, here, this question came up and you kind of answered it. But going to invest 130 to 180 in a 130 to 180K apartment with 20% down ready. If I love the place, should I even worry about the home's value going up? Will it always go up regardless? So you kind of mentioned that a moment ago. So, if you're buying from an investment standpoint, what are you thinking about with terms of appreciation or cash flow? What's the mindset there? What's the conversation?
Here's the deal. You guys have all heard of people that got rich in real estate, and you probably look at some people like, that person is not a genius. It doesn't take a genius to get rich in real estate. It's not a get rich quick scheme. In terms of, if you want to go out and flip 20 homes this year and make $1 million, you could possibly do that, but you could also lose your ass on it. But buying a home with 20% down, let's look at this. Over the long haul, housing nationwide has gone up at a greater rate than the rate of inflation. So recently, inflation has been really low, 2%. It's been hard for the government to get it to 2%, at least by the ways that they measure it. Home price appreciation, depending on where you're at, has been anywhere from 4 to 7% long term. I mean, Southern California is over 5%. Including the great downturns. You go back to the 70s all the way through. It's like 6.5%, 7%. So let's just say inflation runs 2% and you get 3% return. In this situation, you're putting 20% down. So you got 5 to 1 leverage on that. So your 3% appreciation is now a 15% return on your money. Now, at a certain point, as the home value goes up, the leverage decreases and you're not getting as big of returns. But with a rental property, you have someone else making the payment. So you're controlling an asset, you're using leverage, someone else is making the payment, and those payments that they make to you go up over time also because of inflation. So it's actually pretty simple math. You'll see these geniuses on other YouTube channels, on Khan Academy and things of this sort, penciling out how once you factor in inflation and maintenance, you actually can make more money in the stock market. And they go, okay, cool. Well, homeowners on average have 44 times greater net worth than renters. Since the spreadsheet clearly shows that it's easy to do as a renter, why don't people do it? And it comes back to human nature. When you have the mortgage, that's an enforced savings plan. Every month you have to make the payment, and a portion of that goes to principal. Inflation happens whether you like it or not. Over the long haul, that home value is going to go up. You're going to get some tax benefits. The rents are going to go up with inflation. So for all of those reasons, I would never say a home's going to go up regardless. Don't worry about it. I still want a property that's ideal in the market that I'm looking in. So, if you're looking at a bitchin' single family residence versus a duplex that's kind of on the shady side of town, I would almost always lean towards the duplex. Be a lower purchase price per unit. You're going to have higher rent yield, all of that stuff. So really, you want to look at, what am I investing? What is my likely cash on cash return with appreciation? What is my monthly cash yield? Am I having to feed it, or is it bringing in enough money to cover my monthly payment? And most importantly, a lot of our clients on first time buyers on purchases go in and they don't have any reserves. They spend every nickel they have. Things go wrong with housing. It's not a lie to say there is maintenance and upkeep and surprises and things that are going to happen. So just make sure you don't use every last nickel you have. I'd rather have a smaller down payment with a nice chunk in reserves than use every nickel and have a slightly lower monthly payment.
No, absolutely. Absolutely. So let's see, that wrong one. We'll just read it though. Juan, bought my house in June. Super excited how equity continues to grow. Neighbors moving in, paying $150K more than me. Makes me feel like I got a super deal. Yeah, I mean, that's the thing, is that, those that bought, were able to take advantage. And that's one of the things that we've talked about before, is that, the gap, if you will, created not because of COVID, but I mean, it happened during COVID and it was happening before COVID. It kind of accelerated, if you will, is widening, right, between the people that have and the have not, if you will. If you owned stocks, if you owned property, you did pretty well in 2020, 2021, and likely will continue to do so for at least the foreseeable future. And those that don't, it's becoming harder to get into that game. I mean, I've got clients of mine whose parents are essentially pulling money either out of equities or out of checking and savings accounts and giving them to down payment because they're afraid that if they don't help their kids buy a house now, they may never own a home, just because of the direction that it's going. And again, Southern California is an anomaly in the sense that it's, where prices are gone. The whole country's not like that. It's not going to be that difficult everywhere. But here, prices, the median home price in my market's like $1 million now. It's crazy. It's just it blows my mind. I mean, I understand supply and demand. I talk about it constantly, but every single time I sell a property, I'm shocked at what happens, with regards to offers. I'm shocked at what buyers are willing to do. It's so surprising, and it's very difficult as someone that sees the direction of the market. I mean, I have clients, right? For example, I have some clients right now who are friends as well, and wanting to put in offers, for example, on that property that I had, and I struggled like telling them that they should be anywhere near that price. And it's tough because I don't personally think that property is worth that much money, but the market is saying something different. And that is what is very difficult to get across to people. It's like, listen, just because it's happening doesn't mean that I agree with it or think it's a good thing. But at the end of the day, I see it going higher from there. And just, it's tough. It's tough to rationalize, and it's tough to give advice on it. And those of you, and it's not woe is me, right? It's not any of that. It's not a pity party. I'm just trying to convey, like, even somebody that understands why things have been doing this. I've been talking about it since March of 2020, that the market was going to continue to go up because of things that we were encountering at that time. And again, not trying to pat myself on the back, but I understand the market, but yet I still have a hard time giving advice in this market because of how crazy things are. So anyway,
Chip,
I put this on the
yeah,
screen because
you threw that one up and we didn't address it.
yeah. So something that you've said is, the Fed can't raise rates, right? I mean, this comment's interesting. The secret is that the Fed wants to inflate the debt away. The Fed can't raise rates because, as you've mentioned, they service their debt based on interest rates. And if they raise rates, they're paying more money to service the debt that they've created, which, is $30 trillion at this point. So we're talking
we'd love if it was
number.
30 billion. We just pay it off real quick.
Yeah, you could just get Bezos. He could just write a check,
Yeah.
and or Elon, just write a check and pay it off. But no, it's just no. So
No, that is an absolute fact. So the Fed cannot have higher interest rates because it would impact the debt service. When we've gone from whatever the number was when Obama left office, which wasn't that long ago, 7 trillion, we're going to be at 30 trillion really quick. That's 4x the national debt. You cannot even maintain rates. Rates have to go lower. And it's funny, we had a comment, Jennifer had to get after someone over here for making a political comment. Anytime I get someone that is a political zealot that wants to tell me that their side, whether left, right, whatever it is so amazing and they've got it all figured out, I just like to go back to the fact that that's all ideologically driven. So I believe all these things, so I'm a liberal. I believe all these things, so I'm a conservative. And what happens is on the campaign trail, the politicians go out and tell you all of the ideological things that you want to hear. And then they get into office and they don't give a shit about you or me, and they do what they want to do and move forward. So in this situation, to politicize any part of the argument is silly. Republicans and Democrats both like to spend money when they get into government. In essence, they're buying debts. They're going to give a favor to this industry, to this consumer, and they're going to try to buy those votes going forward to maintain and consolidate their power. And remember what I said, Republican, Democrat, it doesn't matter. They are all the same. Once they get elected, the ideology goes aside and it's how can I buy the votes to move forward? And we have all been sold out. And a lot of the issues and problems and things that we're dealing with are because of that. So, like, I would love to say that, hey, let's all get back together here in the middle and join together and realize that Republicans and Democrats are not going to save us. What's going to save us is a commitment to making the difficult decisions and looking at the long term, because the easy shit of multi-trillion-dollar bills passing in Washington, D.C., handing out money to this group, that group, the other group, it just doesn't work. And where I was actually going with that, you guys are here because of housing, and the government's inability to control spending and to give away money to their special interest groups, whoever they are, left, right, center, whatever they're spending money on. We've spent $23 trillion we don't have in the last 10 years. And because of that, the Fed has to manipulate and keep rates incredibly low. And because of that, the people that own assets, that own homes, that own stocks, see those go to the moon. So we also have those same idiot politicians sitting on stage telling us, talking into a camera about how income inequality is so terrible, we're going to do this, that, and the other to stop it. But in the macro, the big things, the unstoppable force of what they're doing is going to continue to make these things worse. So we've also had people on the show here, Jeb, that will pop up in the comments say, oh, don't listen to these guys. They're just trying to sell you on fear of missing out, trying to sell you to get you to buy a home no matter what. The only reason why I care about people buying homes is that number that we talked about earlier. Homeowners end up with 44 times greater net worth. Can you do it as a renter? Yeah, you can, but it is a hell of a journey of discipline, saving, wise investing, just to keep pace with what the average homeowner is able to do. So that doesn't mean buying in at any point. It doesn't mean that the home market is never overvalued. It just means you have to look at the numbers, and when the time is right for your family, plant a stake in home ownership and let the tide take care of itself. Because in our lifetime, in the next 15, 20, 30 years, the government cannot do anything other than support ultra low interest rates, which will continue to push asset prices higher.
Yeah, no, I don't. I mean, I agree 100%. We got Jennifer throwing some fist in the chat here. Talking about politics. Yeah, we don't really like to get into politics here, right? But it's, here we're not saying either side. It's more of a general consensus on politicians are idiots is what I got from what Josh said.
They don't care about us. They care about getting elected. And so they talk and speak to your ideology that you want to hear. And they get into office and they sell that out at first opportunity. And they, meaning the entire political class.
No, absolutely. We're going to move along. We got Hector here. Hector saying, I am closing this upcoming Monday. What should I expect on closing day? So depends. Sometimes on closing day, like here in California, if you were to, I had a property close today, but the owners are staying in it for the next 2 weeks. We closed early. The buyer was able to close early. He wanted to get it done, allowed my clients to stay in it for 2 weeks. So today, nothing happens, right? Everything stays exactly the same. But typically what happens is, the seller would be gone from that property. In theory, you've done your final walkthrough, or at least you're doing it on Monday, when you walk through, to make sure the property's in the same condition as to what you expected, or any repairs that were supposed to be completed are completed. And more or less, you're handed the keys. At least that's what happens here in California. Now, I know some states you sign at a table, and the keys are handed over at that time, and that sort of thing. Here in California, what happens is you sign loan docs. Loan docs go back to the lender. In most cases, the loan doesn't fund that same time. It can, but usually it funds the following day or a couple days later, and then it has to go to the county recorder's office, and records. And once it's recorded is when it's done. It's finalized. At which point the property is owned by you. Then your real estate agent, works with the other side. Up, I heard an 805 get popped, in order to schedule the closing. But in theory, you get the property the same day that you close, and you're a homeowner, right? You can start doing whatever you want to it, and you're good to go. I don't know if there's anything I missed there, Josh, but
No, but why don't you go through the joyous experience that they get in other states, where the buyer and the seller and the settlement agent and the
all sitting
attorney
down.
and realtors all sit and gather around a table and sign everything. And from the financing perspective, in California, it doesn't happen that way. You go sign, add escrow, and then on closing day, the
Or a
wire
notary
comes
comes to
in.
your house. Yeah.
Yeah, a lot of other states, like literally either a check or a wire is already pre-scheduled for your scheduled closing date, and you do literally sit around the closing table with all of the other parties, and everyone signs their loan documents. It's a little bit archaic. It's not necessary, but it's just the way they do it in a lot of other states.
Yeah, like you actually meet the person that you're buying their house, and it's a sit down. And I have, you guys have heard me say many times that I network and talk to real estate agents all over the country, part of different mastermind groups, and created relationships over time. And they post pictures on social that their clients are sitting down and they're handing them the keys at the signing, and it just doesn't work like that here in Southern California. So depending on where you are, it might differ just a little bit. But yeah, and let's talk about just the process in general, right? So maybe many of you are new to the home buying process and the process of buying a house, but buyers have a false sense, in my opinion, of what the process actually looks like, right? I mean, they think, okay, it's a 30-day escrow, which means that from the time your offer is accepted, 30 days later you're closing on that property. And a lot of buyers feel like, okay, 30 days, there's something I have to do every day for 30 days, or multiple things I need to do during that 30-day period, each day, or what have you. And the answer is no, not really. I mean, the buyer is really only doing something during that period, probably 5%, I mean, of the time, maybe 5 days. I mean, it's super, super minimal. I mean, you're providing documentation to the lender. In theory, you've been pre-approved, you're ready to go. The lender's just asking you for some additional documentation, updated pay stubs, maybe a letter of explanation on something, or updated something, right? I mean, it could be anything, why you have a deposit here or something like that. You're doing, a home inspection, that's something you're doing in person, but you're not, you're not part of the appraisal. You're not part of the going back and forth between me and the other agents. You're reviewing some disclosures here and there, but it is it's pretty minimal in the big scheme of things. A lot of what you don't see is, the agents going back and forth, facilitating paperwork, escrow doing their stuff, and a lot of what happens is kind of behind the scenes. So it's an emotional process, but just your agent should be able to walk you through that and give you an idea of what to expect. But it's not a lot, to be completely honest. I mean, the hardest part once you have the property is really just staying calm and patient and waiting for the close. Yep.
So
Let's see here. Yeah,
we
go
had
ahead.
we had another good one over here, Jeb, that we skipped over. It's a good one for you here. A blast from the past. Hopefully, not literally a blast from the past, because those are generally not
Oh boy.
good. They're not good. Just keep the past in the past.
Who are
First,
you?
first time buyer question: what are the do's and don'ts of making offers on more than one house? A lot of times, new first time buyers, like, it freaks them out. Like, I'm making contractual offers on multiple homes. What does that mean for me?
Yeah, I mean, here in California, you can do that, right? I mean, there's no obligation, if a seller accepts your offer to move forward. I've heard things in other states about, once your offer gets accepted and so on and so forth, you're in a position where not you have to move forward, but it's a little different in that process. But here in California, do's and don'ts. Um, probably don't want to submit an offer where the listing agent's the same on those two properties, right? You don't want to let them know, but in some cases, it's okay to let the agent on the other side know that, hey, listen, my client likes two properties that they're interested in making two offers, and you were just kind of hedging our bets in this market. I mean, one of the things I'm asking as a listing agent right now when somebody submits an offer is, do you have any offers out on any other properties? And the reason I ask that is because we don't want to accept an offer on a property and get my client excited on something to come to find out that they've have another offer accepted, and that's the one that they really want, and we're wasting our time, right? I mean, I recently had a listing in Irvine here in Orange County, and me and another agent listed properties basically on the same day. And I received a handful of offers. In fact, I showed you guys the Excel spreadsheet of the offers compared to each other. And I don't remember the number on that one. It was like 7 or 8 offers on it. But there was another agent in there. And I called that agent and I said, hey, here's the deal. I received 8 offers. I just want to kind of talk here. There's not a lot we can share, but just make sure I'm not considering taking an offer that you're also considering taking, right? So we're not in that boat. And happens that my client, or the one offer we accepted, they didn't write an offer on that one anyway, so it wasn't something we really needed to get involved in. But there's not really, I don't know that there's a huge downside to doing it unless it's something emotional, like, if you get, somebody came on here the other day and said they wrote 3 or 5 offers or something and all of them got accepted. So it comes down to, okay, at that point, what do you do? But I wouldn't be writing offers on properties just to be writing offers, right? I mean, that's a definitely a don't be making offers on property that you have no intention of moving forward if it gets accepted. I mean, I've had that happen with clients before. It's normal to get cold feet. It's normal to have some reservation going through that process because it's a big deal. It's a lot of money. You're pulling money from your savings, whatever, for a down payment. And, you're taking on this monthly payment that maybe you've never had before. So it's normal to get cold feet. But, I've had clients tell me, well, I didn't really like it anyway. What? Like, well, what are we doing? So outside of that, I don't really know the advice to give. I mean, it's, you also have to have an agent that's willing to work with you a little bit. Now, if you came to me and you said, hey, Jeb, I want to write on offer on everything I've seen, I probably would have a hard time doing it. I mean, I would try to get you to go with the ones that are at the top of your list, right? And then if those don't work out, maybe consider something else. But don't just try to go into it as a game and say, hey, let's get one accepted. No, don't sacrifice. Try to stick to your guns and get what you want. It might take a little bit more time to do it, but to me, that's the better situation. Josh, what
It's
comes to mind for
it's
you?
it's just that such a long-term decision. If you are going snow skiing this weekend, you need a coat that you don't have to go to the snow and not freeze your ass off. You'll go, well, I'll just take whatever coats are available because you're going to use it for one weekend to go back in your closet. Your house is a major factor just in terms of your everyday happiness. If it doesn't fit your needs, if it's too cramped, if you have a terrible neighbor, if you back to a major intersection and there's crashes and the driving you nuts, it can make you very unhappy. There are a few things that can build as much wealth for you and make you as happy as having a home that you love. But on the flip side, that can also drive you nuts. So the thing that Jeb was saying, it can get tricky in a market like this where you have to get competitive and you can't necessarily hold out for your dream home because once that one comes on the market, 20 other people are going to offer on it. But you also can't compromise too much and go the other way because it'll make you unhappy, make you crazy.
No, when you said that, it made me think of something. You said, if you're going snow skiing this weekend, anybody out there watching, I just want to tell you, it's supposed to be 81 degrees tomorrow. Perfect day here in Southern California. That's what we pay for. Pay for weather. We pay a lot of money to live in nice weather. Now, there are people that are going to go skiing this weekend. I feel sorry for those people. I do. I might be at the beach.
They
I
can go
probably will
skiing.
be.
That's also the beauty of Southern California, Jeb. They can go
You
skiing and
can.
then they can come back down and go to the beach the next morning.
There you go. Or you could do it in the same day. So I read this question and I laugh a little bit just because, the boomer generation who controls their government is overhyping the hot housing market so they can sell their homes to the younger generation. Keep in mind, most of these people selling their houses are also buying something else more expensive. So that only works if the boomers are selling and not buying anything else. And so the majority of people selling a home at the moment are in a position where they're buying something else or they've already bought that other property. So, it's a great headline, but the reality is that's not the case. It's the demand is still there, and quite frankly, the boomers aren't selling. That is part of the problem. Is that they thought that the boomers were going to get to an age where they couldn't take care of the properties anymore. They couldn't go up the stairs. A couple things have happened. People have started to live longer. Also, those people that were potentially sellers look at the market and go, okay, so I can buy a smaller house for more than my house payment now, and it's more expensive. How does that work? That doesn't make any sense. And so these boomers are staying put. So that's created this strain on supply, which is adding to the frenzy that we're seeing at the moment. Josh, here's one for you, buddy.
Well,
Did you want
hold
to add
on.
anything on that?
But yeah, I do want to add. So
Yeah.
totally different direction you went with this. Be very careful when blaming others and making another group into the big problem or the negative. You could be perfectly well right. In this situation, boomers could be the most evil generation ever created, and they're conspiring to hoard all the wealth and keep you from your success. But acknowledging that or dwelling on it doesn't fix or make anything better for you. So, as a buyer, you're a first time buyer, you're not in the market. You can't get mad at owners and sellers and go, oh, those people only want this. It doesn't do you any good. It wastes energy. Focus on where you're at, where you want to be,
This
and
is
how you can close
this is
that
a new
gap.
Josh. This is a positive Josh. He had surgery.
They took the negative right out of my shoulder.
Dude, he's come out a new man. This is good. This is good stuff. You guys don't know what you're getting into. This might be a new deal. We just start off here. 2020 is going to be good,
Fred
guys.
Rogers.
So Alex gave me crap below, said I didn't answer his question from earlier. So Alex, I thought I kind of addressed this earlier. That's the reason I didn't go back to it again. But based on current levels of inventory compared to previous years, does it look like the spring is going to be like 2020, hotter, cooler, or is it not possible to know? I think it's going to be a hot housing market in the spring, just because I think you're going to see more inventory come to the market. A lot of those people that have been sitting on the sidelines, those that have been waiting for the right property, are going to get an opportunity to buy something. So in that regard, I think it's going to move strong. I think it would be very, very, very difficult to duplicate 2021 this last spring. I mean, that is, if you saw that again, you should worry, because prices are accelerating way too fast. And people can say that about what's happened now. Prices have gone too fast. Yeah, but we're still right around the trend at the moment, maybe a little bit above the trend line. But if you do another 13, 14, 18%, whatever the appreciation numbers are year over year at that point, you're reaching super high levels of unaffordability. And I think that creates bigger issues, but I don't think you're going to see that. I think you're going to see, again, my guess is, I've said it, and it's not because anybody else is saying, but I think you probably see 5 to probably 8% next year. And you might see it all within a couple of months, and then it might moderate. Like I said earlier, I think you got a lot of people that are ready to buy. And I think if they're given the opportunity, they're going to do it. And then maybe things moderate. I don't know. I really don't. But I don't think you're going to see what you saw last year, or this year, rather.
Let me put Jeb's I don't know into context. I'm going to list off a bunch of people who are big major businesses with whole teams of economists that spend a lot of time, effort, energy, and money on figuring this out. CoreLogic says we're going to see a 1.9% price increase next year. The Mortgage Bankers Association says homes are going to drop 2.5%. And the thing you should take from that is that Mortgage Bankers Association is a group of morons and never listen to a word they say.
But why you also say that, Josh, I do want to say it. Like, I showed a video on them talking about this. What you don't see or hear in what Josh says is they show a decline, but then if you look at the next quarter, they actually show an increase again. So it's super, like, it makes zero sense in why they get to the number that they do, but nevertheless, carry
They're
on.
the most consistently wrong in their projections of almost anyone I know, and that one's the wildest one I've seen in a while. So we've talked about Goldman Sachs here, 16%, Zillow, 13.6%, Fannie Mae, 7.9%, Freddie Mac, 7%. So remember, you've heard it said that opinions are like assholes. Everyone has one. So Jeb just gave you his. I'll give you mine. I would be stoked if we only had 6 to 8% appreciation next year. My fear is it's going to be somewhere in the low double digits, 10, 11%. And that's if you take last year's 6, 7, 8%, whatever it was, this year's 15, 16%, put you in the mid 20s, about 12.5%. The market is going to moderate and cool. But in the high demand markets, there's just the supply demand inequality is not going to get fixed enough. Jeb's listing selling, at $1,080,000 is a prime example that shouldn't be happening. It shouldn't make sense. Agents have adjusted to the game and are pricing things at prices that you're like, that's nuts. And then it still goes 10, 15, 20, 50 over that. You don't see that in a market that's topping. Now, if you're an agent or a professional in a different market and you can tell us different things, I'm totally open to different markets being different. But most of the places that I have my ear to the ground on, it's still too hot for us to not see double-digit inflation next year in home prices.
No, I don't disagree with that. I just don't want to.
You don't want it to be true. It
I
sucks.
don't. I really don't. I mean, and it sounds crazy. I just don't. I'd really like to see moderation. But I don't know. So here's a question for you. So right now, appraisals are an issue, Josh. You order an appraisal, might take a couple weeks to get it back, especially depending on where you are in the country. So Theo's asking, is there anything a buyer can do to speed up the appraisal process?
Yes, pay extortionist prices to the appraisers because they've figured out the game that there are more appraisal orders than there are appraisers to fill them. So if you just put in your standard order, you're going to get a quote like 21-day turn time, 35-day turn time. And Jeb, that's legit. There are parts of the country that are not that sparsely populated. It's not rural Kansas that we have that, but fairly well populated parts of the country where it's 30 to 45 days to get an appraisal back. So we're spoiled that in Southern California that most of our appraisals we can get back within two weeks. But the only way to really accomplish that and to get over the absurd turn time quotes is just to offer a rush fee on it. And what is a rush fee? Just depends on if you're in that market that's 45 days, they might tell you it's $1,000 rush fee to get it in 2.5 weeks. In our market, it's usually $200 to $400 to make sure you have it back in about 10 days.
Oh, there you go. Ty Sue, hi Jeb, looking to move and relocate to Raleigh, North Carolina next year. Do you have any thoughts on the market out there, agent lender you'd recommend? So I'm from North Carolina, from a small town about an hour east of Raleigh. I grew up there my entire life before I moved to California in 2002. And yeah, it's a great area. It has changed considerably since I was there, but I do know it's still, I have a bunch of friends that live there. So it's a great market. A lot of opportunities, all that good stuff, growth, people moving there to get out of the hustle and bustle. You get 4 seasons, you're close to the beach, you're close to the mountains. So you get a lot of cool things living there. Affordability is a lot better than here in California, but it's gone up considerably. So you got to figure out why you're considering it, where you're moving from, figure out the pros and cons for you. Hard for me to answer those. Agent and lender, I know both. So Raleigh is a big spot. You have areas that surround Raleigh that are considered part of Raleigh, but not really Raleigh, like Cary and some of these other areas. So depending on where you're thinking you want to be, would dictate the real estate agent that I would refer you to. It's kind of like being here in Orange County and telling me that you want to buy a house in Corona. Like, I'm not your guy, right? But I have somebody out in Corona I could refer you to. And occasionally you'll get agents that'll drive you all over these places to sell your property when they don't know the market. But if you give me an idea of where you want to be, send me an email or check that link in the description below. Can connect you with a lender and a real estate agent that can help guide you in the right direction. So hopefully that's helpful for you. So, Josh, a couple questions on MI. Yep.
I was going to say, we've got one here that kind of piggybacks off what we were talking about. First of all, Funky Leaf. I love their little avatar. I don't know what it is, but put googly eyes on anything and I'm down. So if we're basically at an all-time high in terms of pricing or value, what's the reasonable timeline to expect to stay in that home to consider it safe to buy now? I don't necessarily think that this market really changes that calculus. Jeb, we generally tell people if you're going to be there less than 5 years, you're speculating. And when you
Yeah.
walk in, you got 5% appreciation you need to get just to walk out even. So at least 5% appreciation to walk out even. So I would like to count on a 5-year time horizon. We just said Jeb and I think anywhere from 5 to 10% appreciation in the next year. So you should be head above water, could sell if you needed to. But things happen. At some point, the market can turn, and they're generally not. It's not obvious of what's coming, that something's going to change and something's going to turn. So I would like to have a 5-year time horizon, especially the less you put down, the longer term you should plan on being comfortable being in that home. Would you anything outside of the norm or our normal advice on that one, Jeb?
No, I don't think so. I mean, again, you got to do what's right for you. Nobody, it's so hard to pick the tops and the bottoms and anything you do, stock market, housing, any of this stuff. You just don't know. I mean, one thing could happen that changes the entire landscape of whatever. But what I can tell you is typically home prices don't drop, overnight. It takes some time for that to happen. Now, if there's a huge financial crisis like what happened in 2006, 2007, which I don't expect at all, that can change the landscape. But again, home prices didn't drop overnight. It took some time for that to fall, for foreclosures to happen and supply to increase, which created, loans to go away for certain borrowers and arms to adjust, or fixed rate, arms to adjust to higher rates and go from interest only to fully there were so many factors that happened in that period, but it boils down to, you know people just when they summarize it, they just say, well, there was a crash. Well, yeah, there was, but what created that was all of these other factors that ended up driving supply up and people couldn't get financing. So whatever happens, it's not a switch overnight, but you got to do it for the right reasons. Why are you buying a house? How long are you going to be there? Like Josh said, I always say 5, 7, 10 years is kind of a good number. I think the latest stat I saw, and this is not verbatim, an actual quote, but I think it's like the average person is staying in their house now. I think it was like 8 or 9 years, where it used to be like 5 or 6. I mean, it was,
I think it's even longer than that,
yeah,
Jeb.
it might be longer.
Yeah.
And so the majority of people that are buying houses now are staying in them longer. And I think that those numbers are going to grow exponentially because of where people's payments are rate wise, unless rates continue to go down, which, we do think rates might trend back down at some point in the future. But, can they go low enough to even drive payments even lower? And if they do, then that really keeps people in property. So hard to say, but I think, just got to do what's right for you. And like I tell everybody, stop worrying about the price of your home. Can you make the payment? Are you going to be there long term? That's what you should worry about. Everybody looks at their damn house price. Like, it's so crazy. Like, it's never been like this before. But now people have access to all this information, which a lot of it's not accurate, and they continue to just follow it, like a stock.
Well, Jeb, let's respond to another comment here. And there's actually a good story that I like to tell this one. So Jason Good says, it's a great time to sell, not a great time to buy. Is it an ideal time to buy? No, because home prices are so elevated. But as I said here 1,000 times, in 2010, I was screaming from the mountaintops to anyone who would listen. If you can scrape together a down payment, buy a house. It is cheaper than renting, and these are going to increase in value. I did not expect those homes would double in value in 10 years, but we knew they were going up, and we knew you could lock in your payment and start making principal payments. An example, 2 houses that my partner and I flipped on Vine Street in Anaheim. We bought them for $220 or so, put about 50, 60 grand into them, and sold them for just shy of $400,000. At that time, we sat there and said, wow, that is amazing that we're getting $400,000 in a market that wasn't great. And we got about $399 for them, just shy of 400. One just came up across the market, across the street, just came on the market, and almost identical to our homes, but obviously renovated here recently. They just sold it for $730,000. So the people that we've been in contact with the people that we sold the one to, and they're going to move out of state. They bought it for 400. They paid it down to about 320 over that time. They did FHA financing, and now it's worth 700. They got $400,000. They can move to Tennessee and buy a nice house for $400,000. So that I kind of got off track of saying when was the ideal time to buy. That was the ideal time to buy. You couldn't lose. You could not lose. But if we look today, that I would say confidently over the next 10 years, we will see greater than 3% home price appreciation. So it ends up cumulatively about 35, 36%. So buy a $300,000 entry level home. Flash forward 10 years, even though you're buying at a peak all-time high price, you're looking at a $400,000 home. You'll have paid that $300,000 mortgage down to 250, 260. You're sitting on $150,000 of equity that you would not have otherwise had. You were going to pay rent to someone else that would have been increasing over the time. So basically, for the outlay of what a housing payment, a shelter payment was going to be over the next 10 years, you will come out ahead under probably the worst case scenario I could tell you for what would happen to home prices over the next 10 years. So no, it's not ideal. It's not get rich prices to buy in. But if you have reached the point in your life where you have a family, you have a wife, you have kids, you want to put down roots, you want to, connect with your community, by all means, buy a home and don't stress over the fact that it's not as ideal as having done it 3 years ago. We can't change the past. We can only act moving forward. And I still think anyone buying a home with a long-term time horizon of 5, 7, 10 years is going to come out well ahead of the alternative.
I like it. No, I agree 100%. We got a couple questions here on PMI. The first one is a bit disappointing that somebody didn't tell them this before getting an FHA loan. But Andy is saying, just bought my house as FHA with 3.5% down. When does my PMI go away? Do I have to refinance? So, Josh, you buy a house, you get an FHA loan, you put 3.5% down. That mortgage insurance never goes away, right?
Never goes away. There for the life of the loan, and it's a stupid change. It was HUD during the Obama administration, in reaction to the housing crisis, said, hey, the FHA mortgage insurance fund is underfunded. So we're just going to change this and make it permanent. There are very, very, very few loans. Previously, you had to have it for 11 years, and then you could get rid of it. It would automatically fall off at a certain point. Very few loans run more than 11 years. So it's not like this is adding significantly to the FHA mortgage fund, but it leads to mortgage insurance fund, but it leads to people having negative thoughts or thinking, oh shit, did I do a bad thing taking an FHA loan? No, you're going to build up some equity and sell and buy a new home. You're going to build up some equity. You're going to refinance. You'll be able to get out of the mortgage insurance eventually.
Yeah, and you would do that by refinancing. Yeah, you would have to refinance in order to get rid of it on FHA if you did the 3.5% down. So let's talk about this, Josh. Just side note for a sec. Do you think at some point FHA could remove that requirement, keeping it on?
It would make all the sense in the world. And so I've been doing this since 95, and we've had probably 4 or 5 major changes to FHA mortgage insurance through that time, either the upfront mortgage insurance premium, the monthly mortgage insurance premium, or the duration for which you have to keep it. So there's precedent for changing it and adjusting it as the FHA mortgage insurance fund is well capitalized. So it would make all the sense in the world. The biggest thing that's crazy about FHA is that it's truly a socialist program. They spread the risk evenly around everyone. If you have a 580 credit score, you pay the same mortgage insurance as a guy with an 850 credit score. So I would love to see at least some modernization in there to acknowledge that the 580 credit score is a much greater risk to that mortgage insurance fund than the 850 credit score is. But yeah, I wouldn't be surprised to see either a decrease in the upfront, a decrease in the monthly, or removing that life of loan requirement, which is just, it's kind of silly that it's there to begin with.
Yeah, and honestly, like, I mean, the more I think about, the direction that the market's going, home values, affordability, it makes more sense now than ever to make that a shorter term thing and or lower the cost in some way to give buyers buyers more purchasing power, if you will, and or a lower monthly payment if they're staying at that payment price. I mean, that something needs to change somewhere, and you can only do so much, right? You can't give away free loans and you can't do these things, but you can make some of the loans that are out there a little bit more desirable, a little bit more, less, because what happens is the FHA, they build this in there and then people just get rid of the damn loan, and then they lose the loan entirely, and they're not making any additional money on it. Whereas if they just let the mortgage insurance drop off, they're in a position to at least keep, and getting the interest off the loan, and so on and so forth,
Well,
right?
think about this. There's very few people that are still going to be in that loan in 11 years. And if we had a housing crisis 11 years into the future, what are we talking about here? These people have paid their home down 25%. They made a down payment. It should have appreciated over that timeline. Those are not the loans that are going to
Yeah,
present a
risky.
risk to
Right.
the mortgage insurance fund. So again, we're socializing potential future losses. For the last guy in that loses a bunch of money gets offset by the guy who's made his payment for 11, 12, 15 years. Guy or girl, they all can make their payments. Don't want to get canceled,
That's
bro. I don't want to get canceled.
bro, that's such a cancel culture statement. Let's see here. Jose has a similar question, one we get often. Buying a new build in Texas, completed in March of 2020. If it appreciates with 20% equity with my down payment, will I not have to pay PMI for a conventional loan? Josh, so my home appreciates in the time that I go under contract. If it's a new build, a purchase, whatever, I gain that equity. Am I in a position now where I have 20% down in theory, or am I still paying that mortgage insurance?
No, the lenders are looking for skin in the game. So they base your loan to value off the lesser of the purchase price or the appraised value. So in this situation, your purchase price is set, the home's increasing in value through the escrow period, and the value is going to be much higher. They're going to use the purchase price to set the loan to value. The good news is you only have to be in that loan for 6 months, and you can refinance using the new appraised value. So Fannie and Freddie require 180 days in a home before they'll use a new appraised value versus the sales price. So again, the advice I always give is do a no-cost loan on the purchase, knowing that in 6 years you take a slightly higher interest rate, you get big lender credit to cover all of your closing costs, and then you're going to come back in 6 months and refinance into a new loan with no mortgage insurance.
Good stuff. Here's one similar question. When you refinance an FHA loan to get rid of mortgage insurance, do you have to restart your progress in paying interest, Josh? So do you restart a 30-year loan, or is there a way to change that?
I'm going to plead ignorance on this, and I feel dumb for being ignorant on a conventional loan. Fannie Mae, Freddie Mac, the bond pools that those are sold into are very flexible. So we can do custom terms down to the month. So if you're 42 months into your loan, we can do it, 360 minus 42, a 318-month loan. So you're starting right back at the same point.
Well, I
You won't
think
be
you
as
answered the question with that, because he's saying when you refinance your FHA to get rid of mortgage insurance, which means you go into a
okay.
conventional loan. So
Okay.
you,
Yep.
yeah.
Yep. And what was throwing me off is I'm not sure we have that flexibility with FHA loans. Most of our FHA buyers that are doing a streamline aren't they're wanting maximum payment savings, so they're not interested in shortening that term. But yes, 100% with a conventional loan, Fannie Mae, Freddie Mac, we can pick any custom term you want, and either shorten the term. Maybe in that instance we go to a 300 month to actually shorten up the term, or you keep it at exactly where you're at with the remaining term of the loan.
All right. So we got L. Vickers and Prati Logan, both similar question here. Moving to Riverside, California in 6 months. Should I buy or rent? First time buyer, proof of 450, looking at Riverside, Corona. Is it wise for me to buy a house or a condo? So, okay. So I sorry, I got the questions confused. So let's go to the first one, buy or rent. Kind of talk about this all the time. You've got to compare the numbers and see if you're in a position to buy, it's probably the wise move. If you're not in a position to buy, you're having to stretch yourself. You really can't make it work. It does. I mean, financially, you're not in that position. Then rent. It's okay. Like, you don't have to buy a house just because everyone else is buying a house, or that we're on here talking about housing prices going up. Housing prices have gone up my entire life. And I just happened to buy a property when I did. It was the right time in my life to own a property. And so you've got to figure out what that is for you. If you're planning on maybe living in somewhere short term, you don't really know where you want to be, you're not really familiar with the area. All of those things are really a good reason to rent, right? I mean, But if you know the area, you know that's where you're going to be long term, you're in a financial position, you have the down payment, you have savings, you're comfortable with the monthly mortgage payment, I would tell you to buy a house. I think, again, we've talked about this many times. I think home prices a year from now are going to be higher than they are now. So that doesn't mean you should own a house just because I say that. It just means that if you're thinking of waiting because you think it's going to become more affordable, I think that is the wrong reason to wait, personally. But that's me. Anything you want to add to that, Josh, before we go to the other?
No, it's a reiteration of the thing that we said in the question we had answered earlier. If you have a long time horizon, 5+ years, if you buy, the home's going to be worth more next year. You'll made some money on appreciation. You'll have paid the mortgage down, so you'll have built up equity and wealth. In exchange for that, you will pay more than what it would cost you to rent in Riverside County right now. Shouldn't be too much of a premium. It should be more than offset by that gain over the long haul. So I just always fall back to have a 5+ year time horizon. Make sure it's the right time in your life that your relationship, whether it's spouse, boyfriend, girlfriend, kids, all of that is conducive to being in one place for an extended period of time. And at that point, you really can't lose, as long as you make a prudent decision.
No, good stuff. Good stuff. I saw one more. Oh, so that's the question I was going to. Prati. I read the question earlier. So, should I buy a house or a condo? So, there's benefits to owning both. I think. You've got to figure out what's best for you. Condos are great from a low maintenance standpoint. Less to take care of. Usually a little bit more affordable in many areas. The downsides would be you have an HOA, but the nice thing about a condo is like you pay that HOA. You're basically paying your maintenance up front for the exterior and the repairs. If you're in a good community, that the stuff they will do. Whereas a homeowner, if you own a single family, you've got to save for those things or come up with the money at the time that they're due. Condos typically appreciate at a slower rate than a single family home. In the market that we're in now, we're seeing less of that. But traditionally don't not as fast appreciation as say a single family. Single families, detached walls, more freedom to do what you want to your property, change it, all of that good stuff exterior wise, unless you live in an HOA. So there's definitely perks to both. It just really depends on where you are. You have a 450 budget. Unfortunately, 450 is not going to get you a lot in Riverside and Corona at the moment. A couple of years ago, it would have gotten you a pretty decent single family home. I don't know what 450 gets you in that market now. Probably, I mean, you might still be able to do it, but it's not going to be, what it was a couple of years ago. And that's, I know that doesn't help you in any way. But you've got to just figure out which type of property. It's hard for me to answer that question for you. Do you want a yard? Do you have pets? Do you these are all things you need to factor into. Do you plan on having kids? Or all of that stuff should factor in your thoughts on what you plan to do. Anyway, let's see here. Well, we pushing almost 6:00. So, Josh, what do you say we answer a couple more questions and cut this thing at 6, buddy? So
that works for me.
It's Thanksgiving tomorrow.
I'm here at the in-laws, and we're actually celebrating Thanksgiving tonight so that we can have leftovers tomorrow, and then I can jump on a plane back to California on Friday.
I like it. Good stuff. So there's not really a lot of questions out there at the moment that I really see.
Jennifer has a good one, and I don't want her doing a super chat to get her question answered here. So if I don't have enough for 20% down payment, minimum 10%, but I can swing 15%, would that be doable? The only place where this really comes into play is just your debt to income ratio. So the more you put down, the lower the mortgage insurance is going to go. And then at 20%, it would disappear entirely. So if we only do 10 or 15%, we're going to have a slightly higher payment. We have to account for that in the debt to income ratio. So it really just depends on how far you're pushing the ratios. I know you to be somewhat conservative along those lines, so I don't think you're pushing it to an extreme level. Probably not going to be a problem. And then the situation that we talked about last week, United Wholesale just came out with an offer on purchases for borrowers with 680 credit scores. They're basically waiving the MI requirement for anything from 90.01 to 89.99%. So it might be worth talking to a broker and making sure they have access to that program and just running the numbers. There's no free lunch. Everything's always baked into the cake. So talk to a broker in your area. that can connect you, and we can connect you with one that can kind of go through it and show you if that's the route to go with it.
No, good stuff. So I started this by telling you guys, many of you weren't here. We started early tonight, just, because had an idea that we were going to cut this short just because tomorrow's Thanksgiving. You guys should be enjoying some downtime, probably have tomorrow off, or hopefully you have tomorrow off. But just want to say, again, thank you guys for showing up here every week, the support, the questions, all of that good stuff. I'm grateful for all of that, the community that we're creating, and hopefully helping people understand the intricacies of the housing market and how to make better decisions in the process. And so I'm thankful for that. Again, we show up every week. Next Wednesday, I will not be here. So that I need to mention. Josh can come on here if he wants.
Are you
But
having your shoulder replaced next week?
I will be in Sedona. My wife and I's 10-year anniversary. We are doing a little road trip. We're going to go hiking and enjoy the outdoors, if you will. So we will be gone, and I'm pretty sure I'd get divorced on my 10-year anniversary if I showed up with a computer to do a live. So we're going to avoid doing that and try to take in the scenery, if you will. So
you're not allowed, Jeb, to have been married for 10 years because that makes me way too damn old.
Dude, it's crazy. It's crazy. Feels like 100. No, I'm kidding. But thank you guys for all that. Hit the like button if you appreciate us being here. You can hit the like button. It only says dislike now. It won't show me the numbers anymore. So like all of you could hit the dislike and it would just look like 1. But anyway, Josh, anything you want to add?
No, I'm going to answer one question on the way out because it's easy. Mo Theory says, so bottom line, the peak hasn't been reached yet. That is correct. We have more room to run.
All right, guys. That was an easy answer. Adios. Thank you. Appreciate you. Have a great Thanksgiving. Eat some turkey. Take a nap. All that good stuff. Bye.